What you're about to hear is going to sound impossible. It's going to sound like one of those conspiracy theories that gets dismissed by the mainstream financial media. But I need you to stay with me, because what's happening right now in the precious metals market is something that only occurs once or twice in a generation. And if you miss this window, you're going to spend the next decade watching from the sidelines as wealth transfers from those who didn't see it coming to those who position themselves correctly. Right now, at this very moment, there's a countdown clock ticking. You have roughly 24 hours to make a decision that could define your financial future for the next 10 years. I know that sounds dramatic. I know it sounds like hyperbole, but let me show you exactly what's happening behind the scenes, and then you can decide for yourself whether this is something you can afford to ignore. Let's start with something most people don't know. Central banks around the world have been accumulating gold at a pace we haven't seen since the early 1970s. We're talking about hundreds of metric tons being purchased quarter after quarter. The People's Bank of China, the Reserve Bank of India, the Central Bank of Russia, even smaller nations you've never heard of are stockpiling physical gold like their currencies depend on it. Because guess what? They do. But here's where it gets interesting. These aren't just routine purchases. These central banks are buying gold and not reporting the full extent of their acquisitions. They're using intermediaries, they're buying through private channels, they're doing everything they can to accumulate without moving the market too much. Why? Because they know something that most retail investors don't. They know that the current price structure is artificial. They know that the paper market, the futures market, the derivative market, all of it is built on a foundation that's about to crack. Think about what happened when Nixon closed the gold window back in '71. The dollar was no longer backed by gold, and what followed was a decade of monetary chaos. Gold went from $35 an ounce to over $800 by 1980. That's not a typo. That's a 2,200% increase in less than 10 years. And that was during a time when the global economy was far less interconnected, far less leveraged, and far less dependent on fiat currency than it is today. Now, I want you to imagine something. Imagine you're sitting in a room with the finance ministers of the BRICS nations: Brazil, Russia, India, China, South Africa. These aren't small players. These are countries that represent billions of people and trillions of dollars in economic output. And they're all having the same conversation. How do we reduce our dependence on the US dollar? How do we protect ourselves from currency devaluation? How do we build a system that doesn't rely on Western financial infrastructure? The answer they keep coming back to is gold, physical gold. Not paper promises, not ETFs that may or may not have the metal they claim to hold, not futures contracts that get settled in cash. Real, tangible, hold it in your hand gold. And they're not just talking about it, they're executing on it right now. Before I go any further, I want to mention something quickly. If you're watching this and you're thinking about your retirement, about how to protect what you've spent decades building, I put together a free guide that breaks down the strategies thousands of American retirees are using right now to safeguard their wealth. It's in the description below. No cost, no obligation. Just information that could be incredibly valuable given what's coming. Grab it while you're thinking about it, and then come right back, because what I'm about to show you next is critical. All right, let's talk about silver for a moment, because silver is where this story gets even more interesting. Gold gets all the headlines. Gold is what central banks buy. Gold is what investors think about when they hear the word precious metals. But silver? Silver is the metal that's going to shock everyone. Here's why. Silver has industrial applications that gold doesn't. Solar panels, electric vehicles, electronics, medical devices, water purification. The green energy transition that every government in the world is pushing, it can't happen without silver. And I'm not talking about small amounts. I'm talking about massive quantities of silver that need to be mined, refined, and manufactured into products that are supposed to save the planet. But here's the problem. Silver production has been relatively flat for years. The easy deposits have been mined. The high-grade ore is gone. What's left requires more energy, more capital, and more time to extract. Meanwhile, demand is exploding. Not just from industry, but from investors who are finally waking up to what's happening. Let me give you a specific example. There's a phenomenon in the silver market called the gold to silver ratio. Historically, this ratio has averaged somewhere around 15 to 1, meaning 15 ounces of silver would buy you 1 ounce of gold. That's roughly the ratio at which these metals exist in the Earth's crust. But right now, the ratio has been swinging wildly, sometimes reaching levels that make absolutely no sense from a fundamental perspective. When that ratio gets stretched too far in one direction, it eventually snaps back. And when it snaps back, the moves are violent. We're talking about silver outperforming gold by multiples. We're talking about gains that happen so fast that if you're not already positioned, you miss the entire move. Now let me tell you about something that happened in the COMEX warehouses recently. The COMEX is where the paper silver market trades. It's where the big banks and institutions place their bets on where silver prices are going. But the COMEX also has physical warehouses where actual silver bars are stored, and over the past several months, something unusual has been happening. The amount of silver available for delivery has been dropping. Not slowly, rapidly. Eligible inventory, which is silver that's available to be delivered against futures contracts, has been declining to levels that should be setting off alarm bells. But you don't hear about this on CNBC. You don't read about it in the Wall Street Journal. Because if people understood what this meant, there would be a rush into physical silver that would break the market. Here's what it means in plain English. The paper market, where most silver trading happens, is built on the assumption that only a small percentage of contracts will ever demand physical delivery. It's like a bank that operates on fractional reserves. They don't have enough cash on hand to give everyone their money if everyone showed up at the same time. The system works as long as everyone plays along. But what happens when people stop playing along? What happens when industrial users who need physical silver for manufacturing start demanding delivery? What happens when investors who've been burned by paper promises decide they want the real thing? What happens when countries that are building strategic reserves decide they need metal, not contracts? The system breaks. And when it breaks, the price discovery mechanism that's been suppressed for decades suddenly has to reflect reality. And reality is that there's not enough silver to meet demand at current price levels. Not even close. Let me take you back to 2011 for a moment. Silver went from around $18 an ounce to nearly $50 an ounce in a matter of months. That's a 177% gain in less than a year. And that was during a time when the fundamentals weren't nearly as tight as they are now. That was before the green energy boom. That was before electric vehicles became mainstream. That was before solar installations became a national priority in dozens of countries. If silver could move like that back then, what do you think it's going to do now? When the supply situation is worse, when industrial demand is higher, when central banks are buying precious metals like there's no tomorrow, and when the dollar's purchasing power is being eroded by inflation, that's not going away, no matter what the Federal Reserve tells you. But here's the thing that most people miss. It's not just about the price going up. It's about what that price increase represents. When gold and silver start moving, it's not because people suddenly decided they like shiny metals. It's because confidence in the existing monetary system is cracking. It's because people are looking for alternatives. It's because the game of musical chairs that the global financial system has been playing for decades is running out of chairs. Think about what's happened over the past few years. We've seen bank failures. We've seen currency crises in emerging markets. We've seen inflation rates that were supposed to be transitory become persistent. We've seen central banks that swore they'd never print money again fire up the printing presses the moment things got uncomfortable. We've seen debt levels that would have been considered insane 20 years ago become the new normal. And through all of this, what have the smart money players been doing? They've been buying gold, they've been buying silver, they've been moving out of paper assets and into hard assets. Not because they're pessimists, not because they're doomsday preppers, but because they understand how the game works. They understand that when the music stops, you want to be holding something real. Now, let me tell you about a conversation I had with a mining executive a few months ago. This is someone who's been in the industry for 30 years, someone who's seen boom and bust cycles, someone who's not prone to exaggeration. And he told me something that stuck with me. He said, "The market has no idea what's coming. The supply deficit in silver is going to make the oil shocks of the 70s look tame by comparison." Think about that for a second. The oil shocks of the 70s reshaped the global economy. They caused recessions. They toppled governments. They changed the way people thought about energy and resources. And this guy is saying that what's coming in silver is going to be worse. Why? Because you can't just turn on a silver mine the way you can increase oil production. It takes years to bring a new mine online. It takes billions of dollars in capital investment. It takes permits and environmental studies and infrastructure. And even then, you're dealing with declining ore grades and increasing extraction costs. The easy silver is gone. What's left is harder to get, more expensive to process, and less profitable at current prices, which means that unless prices go significantly higher, new supply isn't coming. And if new supply isn't coming, and demand keeps increasing, what do you think happens to price? It's not complicated. It's basic economics, supply and demand. Except in this case, the supply is constrained by geology, and the demand is being driven by forces that aren't going away. Let me shift gears for a moment and talk about something that doesn't get enough attention. The paper, gold, and silver markets are massive. We're talking about trading volumes that dwarf the physical market by orders of magnitude. On any given day, more gold and silver trades on paper than exists in physical form in all the vaults in the world. Think about how insane that is. It's like having 100 people claiming ownership of the same car. As long as nobody tries to drive it, everything's fine. But the moment someone shows up with their title and says, "I want my car," the whole scheme falls apart. And that's exactly what's starting to happen in the precious metals market. More and more investors are demanding physical delivery. More and more institutions are moving metal out of the COMEX and into private storage. More and more countries are repatriating their gold from foreign vaults. Germany did it. Austria did it. Hungary did it. These aren't small countries. These are sophisticated nations with smart people running their central banks. And they all came to the same conclusion. We want our gold back. We want it in our vaults. We want to know it's really there. Why do you think that is? Why would a country go through the expense and logistics of moving tons of gold across the ocean? Because they don't trust the system anymore. Because they've done the math and realized that when things go sideways, paper promises aren't going to cut it. And here's where it gets really interesting for you. Because if central banks and sovereign nations are worried about this, shouldn't you be? If the people who have access to information that you and I will never see are taking action, shouldn't that tell you something? Now, I know what some of you are thinking. This sounds great, but I'm not a central bank. I don't have millions of dollars to invest in gold and silver. What am I supposed to do? And that's a fair question. But here's the beautiful thing about this opportunity. You don't need millions of dollars. You don't need to be an institution. You just need to understand what's happening and position yourself accordingly. Speaking of positioning yourself, if you're sitting on retirement savings, if you've got money in a traditional IRA or a 401k, there's something you need to know. You can move a portion of those funds into physical gold without triggering taxes or penalties. It's called a gold IRA, and it's one of the most powerful wealth protection strategies available right now. I put together a comprehensive guide that walks you through exactly how it works, what the rules are, and how to do it correctly. It's in the description. If you've got 100,000 or more in retirement accounts, this is something you need to look at. Not next month, not next week, now. Because the window for doing this at favorable prices is closing fast. All right, let's talk about what happens next. Because understanding the problem is one thing. Understanding the solution is another. And the solution isn't complicated. It's not some exotic trading strategy. It's not some high-risk speculation. It's simply owning physical gold and silver before the rest of the world figures out what you already know. But timing matters. And this is where the 24-hour window comes in. Right now, prices are at levels that won't last. The technical charts are showing patterns that historically precede major breakouts. The fundamentals are screaming that something big is coming. The institutional positioning is telling us that smart money is accumulating. All the pieces are in place. But markets don't move in straight lines. They move in waves. And right now, we're at the bottom of a wave that's about to crest. When it does, the move is going to be fast. It's going to be violent. And it's going to leave a lot of people behind. I've been studying these markets for years. I've seen the patterns. I've watched how these cycles play out. And I can tell you with absolute certainty that we are in the early stages of a move that's going to reshape wealth distribution on a global scale. The people who position themselves now are going to look back in 5 years and realize this was the decision that changed everything. The people who wait are going to look back and wonder why they didn't act when the signs were so obvious. Let me give you another historical example. In 2008, during the financial crisis, gold was trading around $800 an ounce. People were scared. The stock market was crashing. Banks were failing. It felt like the world was ending. And in that moment of maximum fear, gold started climbing. By 2011, it had reached over $1,900 an ounce. That's a 137% gain in 3 years. But here's what's important. The people who made that gain weren't the ones who bought at the top. They were the ones who bought when everyone else was panicking. They were the ones who understood that crisis creates opportunity. They were the ones who had the courage to act when it was uncomfortable. And right now, we're in a similar moment. Not a crisis yet, but a transition, a shift, a reordering of the global financial system that's happening in slow motion. And the people who see it coming, who understand what it means, who take action before the crowd, those are the people who are going to come out ahead. Now let's talk about silver specifically for a moment, because I want to make sure you understand just how asymmetric this opportunity is. Gold is great. Gold is the monetary metal. Gold is what central banks buy. But silver? Silver is the speculation. Silver is the leverage play. Silver is the metal that's going to move multiples of what gold moves. Why? Because the silver market is smaller. Because industrial demand is growing faster. Because the supply deficit is more severe. Because the price has been suppressed for so long that when it finally breaks out, it's going to make up for decades of underperformance in a matter of months. I'm not saying gold isn't important. I'm not saying you shouldn't own gold. I'm saying that if you want maximum upside potential, if you want the kind of returns that can actually change your financial situation, silver is where you need to be paying attention. And here's something else to consider. The ratio between gold and silver prices has been historically out of whack. When that ratio normalizes, and it will normalize because it always does, silver is going to outperform gold by a significant margin. We're talking about potential gains that could be 3, 4, 5 times what gold delivers, maybe more. But you have to be positioned before it happens, because once the move starts, once the momentum kicks in, once the algorithms and the trend followers and the retail investors all pile in at the same time, the price is going to gap up so fast that you won't be able to get in at reasonable levels. This is what I mean by the 24-hour window. This is what I mean by final call. The setup is perfect. The fundamentals are aligned. The technicals are confirming. The institutional money is moving. Everything is pointing in the same direction, and that direction is up. Now, I want to address something that I know some of you are thinking. What if you're wrong? What if this doesn't happen? What if I buy gold and silver and the price goes down? And those are legitimate questions. But let me ask you this. What's the downside of owning physical gold and silver? You own a tangible asset that's been recognized as money for thousands of years. You own something that can't be printed, can't be devalued by central banks, can't be hacked or frozen or confiscated easily. You own insurance against monetary chaos. Compare that to the downside of not owning it. If I'm right, and this move happens the way I think it's going to happen, you're going to watch from the sidelines as wealth transfers away from people like you to people who saw it coming. You're going to see your purchasing power eroded by inflation. You're going to see your retirement savings buy less and less. You're going to see the gap between those who own hard assets and those who don't widen, to a point where it becomes almost impossible to catch up. Which risk would you rather take? The risk of owning something that might not go up as fast as you hoped, or the risk of not owning something that could be the difference between financial security and financial struggle? Let me tell you about one more thing that's happening right now that most people don't know about. There's a quiet accumulation happening in the physical silver market. Dealers are reporting shortages. Premiums over spot price are increasing. Delivery times are extending. These are all signs that physical demand is outstripping supply. And this is happening while the paper price is still relatively subdued. Think about what that means. It means that the price you see quoted on financial websites doesn't reflect the real market. It doesn't reflect what people are actually paying for physical metal. It doesn't reflect the true supply and demand dynamics. This disconnect can't last forever. Eventually, the paper price has to catch up to the physical price. And when it does, the adjustment is going to be swift and dramatic. We're talking about the kind of move that happens over a weekend. The kind of move where you go to bed on Friday with silver at one price and wake up on Monday with it at a completely different price. And if you're not already positioned, if you don't already own the metal, you're going to be stuck trying to buy at the new, much higher price. Or worse, you're going to be stuck trying to buy when there's no metal available at any price. This isn't fear-mongering. This isn't trying to scare you into action. This is just explaining the mechanics of how these markets work. When supply is tight and demand surges, prices spike. It's happened before. It'll happen again. The only question is whether you're going to be on the right side of it. Now let's bring this back to you. Let's talk about what this means for your financial future. If you're in your 50s or 60s, if you're approaching retirement or already retired, you've spent decades building your nest egg. You've saved. You've invested. You've done everything you were supposed to do. And now you're watching inflation eat away at your purchasing power. You're watching your fixed income buy less and less. You're watching the value of your savings decline in real terms, even if the nominal number stays the same. This is the reality for millions of Americans right now. And it's not going to get better on its own. The forces that are driving inflation, the debt levels, the money printing, the geopolitical instability, none of that is going away. If anything, it's getting worse. So what do? You can't just sit there and watch your wealth erode. You can't just hope that things will magically improve. You need to take action. You need to protect what you've built. And the way to do that is by owning assets that maintain their value when currencies lose theirs. Gold and silver have been doing that job for thousands of years. They did it when the Roman Empire debased its currency. They did it when Weimar Germany printed money into hyperinflation. They did it when the dollar lost its gold backing in the 70s. And they're going to do it again now. But you have to act. You have to make the decision. You have to take the step of converting some of your paper wealth into physical wealth. Not all of it. I'm not saying sell everything and buy gold and silver, but a meaningful allocation. Enough that if things go the way I think they're going to go, you're protected. Enough that you can sleep at night knowing that no matter what happens to the dollar, no matter what happens to the stock market, no matter what happens to the banking system, you've got something real. That's something.